The first step of a backtest is we just trade it with no commission, no slippage, no fees, because that proves that there's edge there.
Hey, what's going on, you guys? Mark Anderson here, construction worker turned 0DT hedge fund manager. One thing that I wanted to do is I wanted to go over recent trade that's been going around some communities I'm in here and talk about it on our back test of the week. Guy in England made this, so we're calling it the British Iron Condor. Initially, let's build on success and start with what I like about this back test and what we think of it initially. So I do not like that we're only looking at the last 2 years because we're filtering out a lot of sample data that could potentially give us more conviction in what we're looking at with trading this. I do like how it's a campaign trade. You can say here that we're trading it 1, 2, 3, 4, 5, 6, 7 times throughout the course of the day. We are also trading every single day of the week. We're using a fixed one lot contract, so we're not going to skew the back test through a huge amount of compounding. We're using a reasonable amount of spread width here, and then it's a ratio that is kind of balancing out the volatility dynamics of the put and the call side, as well, that we're using stop losses that give us the same risk on each side with intermittent stop losses. And then we've included commission, slippage, and fees, and we've capped our losses. When we look at this a little more in detail, though, it basically looks like we're going to get extremely rich. We should book our yacht for the Mediterranean next year. All we have to do is pay $80 a month for automation software. We let this go, and we'll basically be rich and retired. So everyone quit your jobs. However, I wanted to go into this in a little more depth because at its core, we are selling volatility risk premium because we believe that it's rich and it's overstated. That's basically short options. So that is implied volatility minus realized volatility is our profit. However, in real life, it's going to be implied volatility minus realized volatility minus commission, slippage, and fees is actually what's going to result to us profiting in real life. So we only get paid on how we actually perform. I do think that this trade has edge for the IV minus RV part. It looks like a good trade. I like that portion of it. So now it's time to dive a little more deeper into the commission, slippage, and fees. So for an entry slippage of 5 cents, I think that makes sense for getting in an option because the market's not moving around too much. I think it'd actually be around in between 5 and 10 because that long leg is probably going to be around $1 or $2, depending on what time of day. So that's an order that we're going to have a little more slippage on. And then 30-cent slippage, I think that's reasonable. If it's a $6 order that's getting bought back for $9, $15, that may be a little light. It'll probably be between 30 and 40 cents. The other thing too is these later entries, 155, 210, and 55. Those are going to go in the money, especially during power hour. And from personal experience, that's usually around 55 cents, like in the last hour, if you're getting stopped out on these. So this trade looks really good. But the thing that concerns me about it is this concept of we're manufacturing edge instead of capturing edge. And this is why it's really important to look at our back testing software super in depth. So if you look at this, I agree with that slippage of 30 cents. However, in real life, you can see on this stop, we're taking that 1230 stop, and we're adding 960, and then we're adding 30-cent slippage to it. So this order is being shopped as 2 options in real life, but that option isn't shopped in the marketplace as a combined 2 order that has a stop at $22. It's shopped as 2 separate contracts that are filled, that are competed through the environment of the bid-ask spread in an efficient marketplace. So this is calculating a stop. If it was 3-legged and it was saying 30 cents, that is actually 10 cents in the real dynamics if you were trading a single leg trade. And I think this could be shown where is if you look at this trade, we have that 30-cent slippage and we make 817 grand. Granted, we're selling a little more premium, but we basically have a 9% capture. And then if we looked at this other trade, we're selling now same ratio, but less premium, $4.50 and $3. We do now have a little bit higher of a premium capture. However, the money that went down changed. So now, that slippage is being affected a little bit more. And then it's really shown a lot more when we stop the ratio, because this one on a 1-1 ratio is basically showing when we actually take 30-cent slippage and we have a 7.5% PCR. So there's obviously no way, if we're using the exact same times, the exact same dates, and we're selling the exact same effectively strategy that for selling $6 and $4, we have a 9% premium capture. And then while we're selling $4 and $4, we have a 7.5% premium capture. So this is just showing that it's only the backtesting software that's generating that, because $4 is further away than $6. So how on earth would it get stopped out faster with the same exact 960 stop mechanics? And these are the kind of things that we need to contextualize a little more when we're working through these type of backtest, and basically kind of what that means to us in a little more detail. So what I did is I ran this how I think the slippage would be, and what I think people that made this text actually intended it to be. So let's make it entry slippage will go between 5 and 10. So we'll make it 20 cents slippage, because again, we're taking all three of those legs for that entry slippage. And then for the exit, I think it will be 30 cents before power hour, but in power hour, I think it could range up to closer to 50, especially towards the end of the day. So we'll average that at around $1. So when I ran this test, now we've gotten a result of only 4.2 premium capture and 383 grand. Trading the same amount of contracts, the same exact mechanics, the same exact times, the same exact time frame, the same exact parameters. The only thing we changed was the entry slippage and the exit slippage so that it actually reflected. So what this is with that dollar slippage is that's 30 cents per order, which is how it's actually shopped in the marketplace. If you're trying to have a stop loss on 3 orders, I understand you're trying to sell a 3 lot in the marketplace, but all of those are getting shopped to sell individually. So the slippage is basically like 30 cents a leg on those. Else, if that wasn't true, why would we just not trade 1,000 lot? Because if we only have $1 slippage for an entire 1,000 lot, then that's great. So this is kind of an example of manufacturing that edge, and why we need to be careful of how we backtest, and knowing that IV minus RV minus commission slippage and fees is basically equal to our profit. So you can still see here that it's a good trade. Again, I think he nailed the volatility risk premium portion on it. But what I wanted to go over a little more to show this as a real example is we had basically 7,000 trades over the course of this option. Okay, so that's pretty substantial, 7,694 trades. And our average result was $106 per trade. So if we took that many 7,694 and times that by 2.5, because there's a 3 lot and a 2 lot, that's the number of contracts that we actually traded. And now we know that we're looking for 30 cents of slippage for each contract, because that's how it's shown in the marketplace. It's just not how it's tested in here individually. In our profit per trade, which that includes the entire 3 lot or the entire 2 lot, so still 2.5 would be our averages there. So that means 106 for each 3 lot we sell, which is a little concerning, or 2.5 lot. That means that 1 5-cent assumption applied over all of those contracts, which is 19,235, the 7,694 times 2, is equal to $96,175, which if we divide that by our $817,000 P&L, that is 11.7% of our P&L over the course of 3 years is just from 5 more cents slippage per contract on the exit. Because with this trade, and this is why it's so easy to engineer it, is with a 52% win rate, this loses half the time. So it becomes very, very, very prevalent when you're compounding things, when you're compounding $5 times 20,000 over that long of a backtest life. And we can clearly see that represented with 817 grand P&L here, as opposed to the $383,000 P&L here. The other concerning thing I saw with this test in particular is that basically all the gains came in 2022, 311% versus minus 6.07%. And that was historically an amazing year for selling 0DT vol. And you can see it just drastically dropped off. I do think that this trade has solid risk management, and this trade is very good at not losing money, but it's not very good at making money. We can see that here with the 23% return versus the minus 2.8% drawdown. But if we go back to what I think the actual slippage parameters are, so far this year, we've got a 8.12% return with a 8.1% drawdown. So now it looks completely different on what was our test and what we thought it. And I would challenge you, where most people will do is they'll just run this test and they'll give up after a month, or they'll have a really good month because vol was understated and they'll way oversize it, is like actually compare your orders and see if my slippage assumption is off or how close you are to that. But I do think it will end up being about 30 cents a contract is what it'll end up coming out to be on that. So really curious to hear your guys' thoughts. Feel free to comment in the bottom, but I will look into this trade a little more and try and, see if I may actually run it. Another thing that I talked about with this 2022, 2024, I do think that it would be out of bounds to run this since the beginning of SPX dailies in 2016, because the $6 and $4 premium is just going to be wildly different deltas. However, the SPX wasn't that much smaller, and vol was rich enough in 2020 and 2021 to where this shouldn't have mattered, even though SPX was 1,000 points lower. And when we look at the results from that, it's a little more concerning. So it's more in line with our thought that 2022 was an amazing year to sell vol, even with beta slippages would have killed it, but that's obviously in the past. Then we're almost basically a 1 MAR, 8% return, 8% drawdown. And then we look at 2021, great return, 185 versus 42. But then, the 2022 before, when it was more volatile, the portion of 2022 before rates went there and we went to SPX dailies, it didn't do too hot. So for everyone that was kind of like looking at it from a different time period, is again, exact same mechanics here, is back half of 22, 201%, 8% drawdown, front half of 22. So anyone who's really thinking that that's because of SPX dailies, that's just kind of the definition of curve fitting. I wasn't really trying to do anything too crazy, but this is just kind of how I like to contextualize something and beat it up before I start running it and realize it doesn't match what I had tried to buy in the back test. But thank you guys for listening.